Hey, so I'm Ron Sneller, registered financial consultant, and today we're going to talk about the infinite banking concept and why life insurance is the preferred asset to use when we're running the infinite banking strategy. Because there are a number of different accounts or assets that can be used to employ this strategy. Okay. So we're looking at these capital reserve account assets, right? So the capital reserve strategy accounts, you could borrow against a savings account or a CD. You could borrow against a qualified account, like an employer-sponsored 401k. You could borrow against a stock portfolio using margin loans. You could borrow against your home equity by using a home equity line of credit, or you can use permanent dividend-paying life insurance. Now, when you're looking at the different ways to build cash reserves or to build equity within these accounts or assets, we have to look at four key characteristics. Okay. So, number one, how safe is the account or asset? Number two, how liquid is the account or asset? Number three, what is the guaranteed rate of return on the account or asset? And then number four, how is that account or asset managed? Okay, so let's go through this. So we've got a little chart here to kind of compare and contrast. Let's take a look at savings accounts, CDs, money markets, those kind of things. Generally speaking, they're pretty safe. They're readily liquid, but the rate of return pretty paltry. At the time that this is being recorded, February of 2023, the interest rates have ticked up a little bit, but they're still not very competitive. And then how it's taxed, well, the interest that you earn, you owe income tax on that interest every year. Okay. So next up would be qualified accounts, such as the mutual funds held within your 401k. Qualified accounts, are they safe? Not exactly. Most people lost about 20% in their 401ks last year. And then if you think back through the course of the last 20 or 25 years, we know during the financial crisis, because 401ks are tied to the stock market, they lost more than 50%. And then during the dot-com crash in the early 2000s, again, same thing. We had a 50% crash on the S&P 500 there. So they're not safe, unfortunately. Are they liquid? Well, if you want to access that money, as far as like if you wanted to pull money out of your 401k, you got to pay all the tax that you've been deferring, and you have to pay a 10% penalty to access your own money. Not good. Like the 10% penalty is if you're under 59 and a half. Now, you may be able to borrow against it, but there's all sorts of restrictions there. You can only borrow half of your account value or up to 50,000 max. That's the max loan you can get on those 401ks, right? And then you have to pay it back on their schedule, not yours. It's deducted from your paycheck. And if your employment is terminated, whether it's voluntary or whether it's involuntary, that loan is due in full within 30 to 60 days. And if you can't pay the loan back at that point, it becomes a fully taxable distribution. And so not only will you owe the income tax, but you'll owe the 10% IRS penalty on top of that. So what's the rate of return on these 401ks? Not what we're looking for infinite banking. Like the stock market's a yo-yo, right? It goes up and down. Now, ultimately, like with our investment accounts that we're investing for the long term, over the course of the long term, they could be pretty good, right? And so I'm not against the stock market. I am an investment advisor as well. But due to that yo-yo effect with the short-term volatility, that's not the type of characteristic that we want for the infinite banking strategy, right? We need reliable rates of return, reliable capital to be able to execute properly on this strategy. And then the growth, the growth in these accounts are tax deferred. So there could be some tax advantages to qualified accounts. Now let's talk about home equity lines of credit, because a lot of people, especially real estate investors, are already using home equity lines of credit. Now, how safe is home equity? Well, remember the financial crisis of 2008. Everybody learned the hard way that homes can indeed lose value. The last crisis taught us all a very hard lesson, where most people thought that real estate could only go up. And again, right now, February 2023, we are starting to see housing values go down a little bit in some areas of the country. Now, how liquid is it? Okay. Now, look, if you want to get a loan against your home equity, it can generally take 30 days or more, because you have to go through an application process. You have to get a credit check. This loan goes on your credit report. There's job verification, income documentation, You got to send over your tax returns. And even after you do all that, you could still be denied. Okay. Now, what's the rate of return on real estate? Again, we've seen some points in history where the real estate market has come down, but usually it's generally pretty stable, right? And then how is it taxed? Well, listen, there are some great tax advantages to owning real estate and to utilizing HELOCs, which I'm a big fan of. Okay. Um, let's look at stock portfolios. How safe is it? Well, can you lose value? We kind of already talked about that. Of course, it can drop, but if the portfolio drops a certain amount, and I should clarify here that we're talking about a stock portfolio held outside of a 401k or outside of a retirement plan. Okay. So if you have leverage or borrowed against your stock portfolio and that portfolio drops a certain amount, you can always get a margin call on your loan. That means the loan is due in full immediately. And that is an extremely hefty risk to take when trying to build wealth. I would never get into a lot of leverage on a stock portfolio. If I ever did that, I'd be very, very careful. That's pretty risky. There's just much better ways to implement the infinite banking strategy. But let's talk about how liquid they are. Remember, stocks held outside of a retirement account, they're pretty liquid. They can be sold really quickly. You can get a line of credit against it fairly quickly. What is the rate of return on the account? Again, over the long term, it could be really good. Stocks can be a great wealth building tool, but in the short term, and we're using infinite banking, we want to know, like, in the short term, because we can use it often, we do not want that big up and down roller coaster. That's not a characteristic we want. And then how is it taxed? Well, on a stock portfolio, there really aren't tax advantages. It's not like a Roth IRA where you can grow the money tax free and then take it out tax free later. Okay. So we don't really have the tax advantages there. So if you look at these four considerations, stock accounts just hold up. So there are many types of accounts or assets that will kind of work with the infinite banking concept. And some are better than others. Like I like HELOCs better than stock portfolio. And I like stock portfolio better than qualified accounts, right? But there are some that work even better than that. So let's take a look at dividend paying permanent life insurance. Okay. Now, is it safe? Well, guess what? Your account is completely protected from losing principal. And these companies may also pay hefty dividends annually, and that dividend is credited to your cash account. And once that dividend is credited to your cash account, you can never lose that money either. From a safety standpoint, there is no better type of account. How about liquidity? Well, from a liquidity standpoint, the insurance carrier guarantees the loans against your account. You can use the account value as collateral to secure the loan, and insurance companies will loan up to 90% loan to value on these accounts. It's guaranteed, so it's highly liquid. There is no application process, no credit check, no job verification, no income documentation. You don't send over tax returns. You fill out a one-page document, sign your name one time. And our experience has been when we submit that document, the insurance company has the money in your bank account within 3 to 5 business days. So you can get your hands on the money like that as well. And then as far as the payback period, there is no structured repayment period. You set that up for yourself, right? You want a loan payback plan, but if things get tight for some reason, you could always skip a few payments if you needed to. Like for myself, I had an outstanding loan when COVID hit. We were doing some slight rehab on a rental property, and we had just moved in a new tenant. And so when COVID hit, I stopped paying my life insurance policy back because the financial world, we had all this volatility. People were scared. And I didn't know, are people going to quit buying insurance, quit buying annuities, take money out of their investment portfolios? I didn't know, right? So I stopped paying the loan back on my life insurance policy. And it got to a point now, thanks be to God, we did well during that time. And we got to the point where I had the money to pay it back. I just didn't, because I didn't know if we were going to need it to live on. And then we got through the worst of COVID, and then I ended up paying the loan back all at once. I didn't make a payment for about 8 months. And the insurance company never once called me and said, "Hey, Ron, where's that loan payment? What's going on over there?" They don't do that, right? They don't do that. You try doing that with a traditional loan. You take out a loan from the bank to go buy a vehicle. You try not paying that back for a few months. Talk about the repo man coming to knock on your door and take the car away, right? Goodbye. Goodbye to the house, goodbye to the car, whatever the case might be, right? But with this strategy, you're becoming your own bank, and we're putting you back in control of your money. Okay, so that's how that works. Now let's talk about rate of return. Now, the typical rates of return on a life insurance contract are determined by the rates of dividends credited by the carrier. Now, the dividends are not guaranteed, but the insurance company credits you an interest rate that is guaranteed that won't go below a certain number. Generally speaking, most policies, that's 3 to 4%. But again, with the dividends that are credited when they're locked into your account, generally speaking, after we're factoring in the cost of insurance, we're generally looking at somewhere between 4, 5, 6% net internal rate of return on these policies. So these policies are going to get you much better rate of return than what you get in the bank. And so it's going to give you a bond-like return, but no risk of bonds, right? Everybody thinks that bonds are safe. They're not safe. They just usually tend to be less volatile than stocks. But if you look at last year, 2022, the bond market lost double digits. Both stocks and bonds were down double digits in 2022. Life insurance wasn't. Whole life insurance still paid out 5 to 6%. And so when I look at things, if I can get 5 to 6% on a no risk product and it's tax free, that's really, really good, right? A 6% tax free is like an 8% gain in a taxable account. That would be the equivalent, right? And so, I think I would be remiss to say like, hey, I'm comparing it with an investment. But life insurance is not an investment. We are using this in our portfolio as a bond substitute or as a banking alternative. We want to have a predictable, competitive rate of return that we can borrow against. And then how is life insurance taxed? CPA Ed Slott calls life insurance the single greatest advantage in the entire US tax code. When we set people up with these policies, we set it up in a way when the policy is structured properly, once the money goes into the policy, it can never be taxed again. This is a way that you can grow your wealth completely off the radar screen of the IRS for income tax purposes. The money grows tax-free. You can access it tax-free. The retirement cash flow is tax-free. And then when you die, the death benefit transfers to your family tax-free. So when you consider these 4 criteria, the safety, the liquidity, the rate of return, and the tax benefits, dividend paying cash value life insurance satisfies all those criteria the best. Again, safe from loss, it's guaranteed, completely liquid when you use the loan provision. Your money continues to grow and compound at competitive market rates. And again, if you're using the loan provision, all of the money that you're accessing completely tax free. Why? Because we're using a form of debt and debt isn't taxable. So they're safer, more liquid, better rate of return, where it's a stable rate of return. You can use your money tax-free during your working years and then as a tax-free pension during your retirement years. So you guys, I hope this helped when we're kind of looking at what kind of accounts or assets that you can use to implement and utilize the infinite banking policy, why the foundation of that is built using a maximum funded high cash value life insurance. And if this is something that you're interested in learning more, all you got to do is reach out to me. You could send me an email at ronald.sneller@snellerfinancial.com. You can always go to my website at snellerfinancial.com. And I have a pretty large social media presence on Facebook, TikTok, LinkedIn. You could always shoot me a direct message on social media as well. So I hope that this helped, and we'll talk to you guys later. Thanks so much for tuning in, and we'll talk to you soon. All right, bye.